This is part of one of my best trading setups when it comes to trading Forex, indices, gold, commodities. So first of all, what I did was I identified that there was sell side liquidity. So the sell side liquidity beneath this low and that low, you see a whole bunch of accumulation, a whole bunch of consolidation. And all that is just an accumulation of orders, and that is it. Simple. They're accumulating orders. And so what people tend to do, or what people like to do, is they like to jump in from the high of consolidation and sell it down to the bottom, and then take it from the bottom and take it to the highs. As you can see, look, it doesn't really get to the bottom, and at times when price is trading higher, you could be having all kinds of attack on your trading psychology because price is coming back on you. It's coming back on you, and so you're going to be panicking. You might close out the trade early. All kinds of stuff could be going through your mind at that time. That's why it's not ideal to be jumping in during consolidation. There's going to be people out there who trade consolidation. Your boy doesn't do that. They can trade consolidation and be happy with that, but I'm not going to mess around when they are accumulating orders to continue their move either lower or higher. And so in this scenario, they had run buy side liquidity already, all this liquidity over here. There was also sell side liquidity beneath here and over here. And I actually was in a trade from up here, from an up close candle. In fact, let me put on my annotations real quick. There we go. You can see there was an up close candle in here. Price tagged into that and started dropping. But what we're referring to today is when you've missed it from the highest and prices already started moving, this is what we're talking about today, how to catch an entry during that time. We've identified sell side liquidity here and here. And so this is going to be my target. You know, there's going to be tons of money beneath here, tons of money above here. They take that out and then they begin to drop. So now in my eyes is, if I'm, for example, not in from up here, or, you know, for whatever reason, let's say I'm not in a trade and I'm looking to jump into this trade right now, then I'm looking for an opportunity to get in to run out the money beneath all of this and then take the sell side liquidity here and over here too. So what I'm going to do then is I'm going to be waiting patiently for an opportunity to take price lower. And so I'm going to hit play. I might play it one candlestick at a time. I want to go one at a time. There we go. They literally ran this liquidity instant. They just went for it. But what I did was I identified a potential entry to target the rest of that money, because there's still going to be sell side liquidity beneath this low. They've taken the buy side. There is sell side. So even though they've taken this one, there's still more down here. And so what I did was I identified this area of inefficiency, this one right here, as my entry point. And then what I decided to do was I decided to jump in roughly about 50% of this imbalance, because you guys know I like to jump in from 50% with my stop loss. Let me just show it to you on a 1 minute time frame. With my stop loss at this candlestick's high. And then, like I said, the target was sell side liquidity. So you can't see all here, but I'm going to go ahead and go back to the 5 minute time frame. There we go. And I'm going to push it all the way down to this level here. So this was my area of interest to take TP. Let's go ahead and hit play. You can see right here, this is where they traded right into my entry, or into my area of interest for an entry. And now I'm going to show you guys how it played out. There you go. You can see it hit TP instantly. So this is an instant TP hit. From this level here, we targeted the rest of that sell side liquidity and we were out the trade. It doesn't matter if it keeps on running. It doesn't matter if it continues to drop. If your aim is to take out these lows, then go ahead and close that trade, because that was your aim. Now, what I'm going to do is I'm going to go ahead and show you guys my executions to show you this one here. I didn't catch this one on Trading View, but I did catch this one here. So here are my executions. This is that sell side liquidity you can see here. So you can see my sell stops are over here. These were the sell stops. I jumped in literally here, roughly about 50% of that imbalance. And then I took my TP right at this low. So roughly about just beneath the sell side liquidity over here. Let's just see how long the trade took. So this is the candlestick I entered on, and this is the one I closed on. This took 1 hour and 35 minutes, guys. That's a beautiful scalp. So just because you've missed it from the very highs doesn't mean you can't catch a move along the way. As long as you watch the chart and wait for the right opportunity to come, then you should be able to catch another entry. And then look, at the same time, if they don't provide you with one, they don't provide you with one. I was trying to catch an entry to run out this sell side liquidity from around these levels here. They didn't provide me with an entry, so I couldn't get in. but I did see the entry to run out this one over here. So this is one of the main styles of trading that I'm going to be doing. And you know what I'm going to do? I'm going to show you another one on gold. So this one I didn't catch on TradingView. I did catch on MT4 because I wasn't on TradingView at the time anyway. So let's go to gold. All right, guys, so here is another example. I just wanted to quickly show you guys where we are in price first of all. So this is a weekly imbalance over here on gold. Okay, so on the 1 minute time frame, what do we have going on? We can see this is that weekly imbalance, and this is the low that's going to be vitally important for knowing when to go short. When price takes it out, basically it's time to be looking for a short opportunity. But what we're not going to do is we're not going to just jump in based off consolidation or accumulation when price is at a high and it comes up to retest that same high. That's not what we're going to do, because there's liquidity above that. Whenever price does something like that, just know there's liquidity above that. When price traded lower and took out this low, it left inefficiency here. So this is going to be key. This is the giveaway for where potentially you're going to find the best entry from. And so look what happens next. Price goes sideways, once again accumulating orders, generating that liquidity, and then when it gets here, it produces relative equal highs. So I'm going to mark that up too. But once again, this is not your area of interest. This is not your area of entry, because there's going to be money above that. Equal highs. Okay, there's going to be money above that. You don't want to be jumping in on a trade when there's liquidity right above you, which is right here. And so when people got this sign, they would have gone short at this point. They would have gone short and taken price lower, maybe to the bottom of this range or even lower to get down to this low over here. But once again, like I said previously, you want to look for the point of interest that's above the accumulation for an entry. This is where we bring our eyes back to this imbalance over here. That candlestick's wick low and this candlestick's wick high, they do not touch. Only sell sides offered to the market. And so this is ideally where you want to catch your entry from. This is where I had my entry from. And so you can see here, again, let's quickly hit play. See, price taps into that area of inefficiency, as you guys can see, taps right into it. I believe I catch my entry either at 50% or the open. I can't remember now because it was literally like a week and a half ago. But this is where I catch my entry within this imbalance. I put my stop loss above the imbalance and then I target the lows. You can easily just run it to this low over here. So let's quickly mark it up for you guys real quick. You can easily run it to this low. I know we play with percentages, but I'm just going to talk about pips for a second. From that high to this low, we're talking about roughly about 37 pips, and that's beautiful if you catch a very good lot size on that trade, depending on your risk management and your risk to reward. That's very juicy. But at the same time, just because it runs this low doesn't mean it's over. You need to look to the left to see what else they could run through the slow into before turning around. And so this is where I identified also that there was an order block here. And so you can't see it like this, but this is an order block right here. I'm going to go to the 5 minute time frame to show you that. So you can see it right here. This is our order block. This is our bullish order block over here. So I'll mark up, I'm gonna leave it like that. That's our bullish order block. I'll mark it up in gray. There we go. So this is our bullish order block. And so when price runs out this low, we need to run it into something. And so this is where I've decided to run it into my bullish OB. I'm not expecting gold to run out these lows over here and then push higher. I'm going to play it smart, trade well, and take it into something internal. What I'm referring to internal is on this push up higher, what is along the way that price could tap into before it's potentially turning around. And yes, you have the down close candle here. That's another point of interest. But because I'm trading well and playing it smart, I'm going to be taking my TP when price gets to this level over here. Cool, let's hit play. You can see from there, we've run the sell side liquidity beneath that low. That's a good sign. When you've jumped in above accumulation, we've got our entry and then we take out the sell side liquidity. That is a good sign. And so this is your sign to hold the trade. And at the same time, if you're a scalper, then you're out the trade. If you're a day trader, then you're most likely going to be holding onto this trade. Let's hit play again. You can see price trades right into the bullish order block. And so this is the move done. That's all you need after that. That is it done, finito. You're out of the trade. I'm going to hit play a few more times to show you how deep it went again. You see price got to the down close candle, right to the down close candle. So if you had a runner, this is where you would take that. But did it run out the down close candle though? So let's just say you was just hoping you was going to run out that down close candle. What happened? You can see price dug into that down close candle one more time and then started pushing up higher. If you're bullish, then really truly you're not expecting this low to get taken out. Hence why it mitigated at this down close candle and started pushing up higher. So this was another example of one of my favorite styles of trading. Once you get that break of that low and price is accumulating, wait for price to dip its head above, run that liquidity, look for your entry, and then run that money.